Hey, good morning, everybody. Happy Thursday to you. Slightly ahead of the Memorial Day weekend. Don't forget, we have a short week next week with the holiday. I had posted on X yesterday talking about, hey, and I only do this for fun. It wouldn't matter if I get the one like or whatever. I'm still going to post the video. It was just about posting a new GameStop option flow and taking a look at that and cover the millions on those deep in the money puts again. I know we saw those about 25 million worth yesterday, so we'll take a look at that. We'll take a look at how many shares that actually represents. We'll take a look at the daily chart. We'll take a look at that flow. But if you look at the actual net call premium yesterday, it was fairly flat there on GameStop. And then we saw that net put premium here declining, 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 and then ultimately end up being negative 24.85 mil. So we're going to take a look at all of that. We're going to look at the net premium at 23 mil. How that is because both of these were negative figure there, so it's positive in that the puts were sold. Total premium on the day 71 mil. So we'll take a look at that. Some of the highest volume yesterday traded was on the 29 and $30 calls, as well as the 28.50s, all for this week. Short-term expiry, which is usually what you see. Now the 28.50s are just slightly out of the money. I'm filming this video ahead of the market open. GameStop's trading at 28.28, so just slightly out of the money with the day left on expiry. About 11,000 volume yesterday, about 600,000 in premium, and a little bit carried over into new open interest. So maybe some new buyers pulled up to the table, or maybe some new sellers. Either way, a little bit of an increase in open interest, 11,350. And as you know, each contract represents 100 shares. So essentially, it represents about 1.1 million shares worth of call options traded there for that particular expiry. Then we saw the 29s and the 30s, both out of the money as well. Nearly a million in premium yesterday, about 24,000 volume, but it only saw about 450 appear new open interest. So a lot of these contracts more than likely just changed hands and or were scalped yesterday and changed hands from buyers to sellers and sellers to buyers. More than likely the same scenario there with the $30 calls yesterday. Although you saw about 300,000 total premium and about 14,000 volume, not a lot of change to open interest. So, buyers to sellers, sellers to buyers, and vice versa. They trade hands and they're short dated expiry. Some more of those 125 calls. I know some are buying, but some have also been sold. For example, somebody might have bought some here thinking the stock might move up, or there will be some volatility in that regard. But if you look historically at these 125 calls for June, they've been selling them since the beginning of the year at $189, and now they're filling at 16. So if you've been selling these as covered calls, you're probably making money. If you've been buying them all the way, you've been buying them all the way down. So yeah, more than likely, like I said, yes, there's ask volume and bid volume. You can see a good combination of buying and selling both on that particular call option. So you want to be careful with those as well. But let's look at actually where the bulk of the cash was spent yesterday on GameStop. Because we said there was 71 mil total premium, and if you look here, pretty large day we've seen. I think probably the largest since last Friday on the monthly option expiry, which was the 78 mil. So pretty decent day in that regard. And we're going to pull that up and take a look at where those options were, which particular strikes, and we'll break down some of the math on that as well. I'll pull up GameStop here. Get over to my filters here. I'm going to reset my filter real quick because I was doing some specific scanning, which you can do custom filter. That's what's awesome about Unusual Whales. It's extremely granular, so you can use even the just finest minute data points to scan or filter flow or filter for alerts. So what I wanted to do is that, as we always do, is we always sort for the highest premium, and that's what I look for things about higher than 500,000 or more. We look for that premium, where the bulk of the money was spent. Like I said, the $29 calls for this week. 30s for June also saw some more activity on Wednesday, so let's take a look at that here for just a second. There was about a million in premium on that yesterday, about 4,500 volume. Open interest declined just a little bit, so some of these contracts could have traded hands as well. So we'll see that they're just slightly out of the money and still have about a month to expiry. Trading around $190 a contract into the close yesterday. The 29s we talked about, there's some 30s there for July we saw as well. So we're going to pull those up because I noted what looked like maybe some more selling there. It was about $285,000 worth came through here on this particular candle. We see about 3,000 volume yesterday, nearly 900,000 in premium, and the open interest increased by about 1,500, which would definitely cover this particular option right here. Didn't come through as a multi-leg trade, so you don't know. Trader could feel that GameStop is not going to close above 30 on July 18th. So they're going to sell some covered calls and take advantage of that call premium. It could be a couple different scenarios in that regard. It could be something that somebody already sold because um, let's see here. They might have already bought some and taken profits. They could have been buying some here and just decided to take profits because, like I said, if I sell to you or you sell to me, these contracts can change hands and not necessarily impact the open interest in that regard if the position remains open or the contracts trade hands in that regard. Let's see here, but we're also going to look at the puts as well. I was just highlighting the additional ones that were kind of over that 500,000. Saw the 2850 calls for this week as well come through yesterday, about 600,000 in premium. Now there was some volume yesterday, 11,000, about 2,300 new open interests. Those closed around $33 a contract. They were trading as high as around 80 during the earlier in the day. Now with GameStop being 28.33, these are just slightly out of the money. So they expired also tomorrow, so you want to be careful there with the short dated. But let's focus here on those puts. I know. As you can see them here, 125 put, the 120 put, the 115, the 100, the 105, the 90, 110, 95, 80. And if you look at these, some of these were coming through as multi-leg trades here, so connected to other parts of a trade. And then, for example, you'd say, well, what's up with those deep in the money puts? And we've covered it before. It could have been put arbitrage, building. You could build like a synthetic long position using a deep in the money put. And I'll tell you how, or show you how. And you could actually achieve sometimes the shares for cheaper than the current market price. So the way that would work, for example, do you remember when I put up this scenario about the $95 puts? It's the same thing. So essentially, if it's not a 95 or if it's the 125 put, just change the strike and the math will be the same. So for example, on the $95 puts, we'll look at that here. For example, there were some of those yesterday, so that'll be perfect here. We'll look at those. Now you see it's 444 volume. Now before everybody freaks out about, well, yeah, but there was 3 million in premium. Correct, but that only represents 44,400 shares. Still a lot of shares, but it only represents 44,000 because each contract represents 100. So you see about half of that appeared in new open interest today as well. So you'd say, well, hey, if I sold it deep in the money put, wouldn't I be assigned? Potentially you would, and early. Why? Because that you're selling something, a 95 strike, and it's currently in the money. So you'd say, well, why would I do that? Why would I sell to take the money up front? Well, you'd take the credit up front because then if you're assigned, chances are you probably landed the shares for cheaper than the current market price. And I'll explain that with the math here. Let me show you. So, for example, on just say the 95 put, what was the amount of the premium here? I've got in my example 69.30, and yesterday it was 66.57. So the math will be a little bit different, but let's just use from my example as I feel like it'll help illustrate. So if it's 69.30 is the premium times 100 is actually $6,930. So for example, they sold the 444 contracts at the in this example is going to be selling 2,600 contracts times 69.30 equals 18 mil. Well, if 2,600 contracts represents, like we said, each contract represents 100 shares, that's 260,000 shares. Well, 260,000 shares times that $95 strike is $24,700,000. You're like, but whoa, why would I want to pay that? You wouldn't because you actually already received the credit of the $18 million. So that would roughly give you $6,700,000 or $6,700,000 to buy your 260,000 shares, which actually would break down to around 25.76. So at the time of this example, the market price, this when I did this for my last video where I explained the puts, the market price on the stock was 26.04. And then if you went going, basically like think of this like a synthetic long position. Even a short seller will use a deep in the money put as it kind of represents the same scenario. For example, they might have sold the shares short, at the market 2604. Then you can use a deep in the money put in that regard to get the shares and buy them back for even cheaper. So making basically the difference of, like, if I, for the example, bought 260,000 shares at this market price example of 2604, that's my cost, $6,770,400 for those shares. But going this route using deep in the money put option, I would have been able to actually get those shares at 25.70 each, so a little bit less. So you can think of it in that regard for the math. So for example, like a $95 strike minus the premium equals the current share price. So how that works is, for example, the $95 strike on the GameStop put minus the average share price there, we'll just use paid 66.57, is 28.43. And 28.43 is actually higher than the current share price of the stock. So if you take, for example, another way you could look at that is too, if you take the average price of the contract, and then we'll go by this price here, which we'll go by the close price, 28.05. That's 94.62, which is roughly your 95 strike. So it will always equal, for example, like the 125 strike will always, if you take the premium received, will always equal then the share price, if that makes sense. So, for example, like on this 95 strike, uh, these are all intrinsic value because they're deep in the money. So that's why you have those particular put options. Um, so, for example, like if you had the $95 strike and you had to buy shares at 95 if you were assigned, but you already received the credit of $6,930 for selling one of these contracts. So, how that math works out is you'd have your $9,500, which is your 100 shares at $95 each, minus that 6,930 you already received an option premium, equals 2570. And now if you take 2570 divide by 100, because each contract represents 100 shares, that's the 2570 per share. That's the example I was showing you in that regard. So when you look at these other puts here for GameStop that came through, look at the volume. Like this one on the 125 put, it had a volume of 1503, which represents about 150,000 shares. So there was 14 million of premium there. So we'll look at the 125 put so I can show you the math here. 1,500 volume, and again, about half appeared in open interest. Why is that? What changed? Well, they could have got exercise, or pardon me, could have been assigned. So if you take the 125, which is the strike, 125, minus your 96.69 premium there, is 28.31, which is roughly the exact trading price of the stock right now. So depending on when they got in or when, that would give them essentially the same price. For example, say you thought GameStop would be $30 or $40 in January. You don't necessarily want to buy all those shares right now. Sell deep in the money puts. Why? Because if you get assigned, you'll buy. It'll essentially get the stock for the exact market price it's trading right now. Maybe even a few points cheaper, depending on the math. So, for example, let's see this contract here. That was at 96.64. So let's see here. 125 minus 96.64 puts it at 28.36. So a little bit higher than the current share price at the market price. So just a little bit of a premium attached to it, if that makes sense. So for example, that 96.64 times 100 is roughly $9,664. So you're receiving ahead, when you actually sell one of these, because the difference there would be buying 100, 100 shares, essentially 100 at $125 each, would be 12,500, but you'd want to deduct the premium already received, which would be the same as the 28.30 current share price. So a couple different ways you could look at it, but that's why you see all of these for the millions and just deep in the money puts. Could be cat and mouse, like I said, it's a way to create a synthetic long position, and pretty much almost every transaction yesterday for these deep in the monies, literally about half of them came through a new open interest. So some buying, some selling in that regard because of the volume at the time. Let's see here. Let's look at the actual transaction here on, say, these $80 puts. And we'll look at how those came in. So there was one, for example, at 51.65, because if you take 80, which is the strike, minus 51.65, you got 28.35, which is roughly the current share price. So you see a few of those come through, and then a few more start pulling up here, 30, 30, 75. And some of them coming through as multi-leg here. So let's take a look at that. Possible other side of the trade here. Okay, possibly. Let's see here. I'm not sure. That just looks like it's detecting it based on the time that bought $27 puts. Yeah, that doesn't necessarily mean that was a multi leg. I guess it could have been. I think it's just because of the time. It's potentially saying, hey, this is a potential strategy based on the time and the fill. But that isn't necessarily what the case is here. But let's see here. These are just for examples. Same thing where you're seeing the buy 25. It's right around the same time of the fill. Buying $26 puts, selling $80 puts far out, indicating like a roll strategy. Not really, but kind of, I guess. Yeah, so it's interesting just the way it's being flagged there as they come through. But yes, yeah, so, I mean, even like the 95s, which is the exact scenario I just covered, see the 95 puts we saw, 66.57. And I think the math we were using there, let's see, 69.30. So yeah, it's just the same example, but 444, and then about half of those in new open interest. So yeah, you can see the deep in the money puts there, even the 120s, the 115, same scenarios like 120. If you do the math there, take your strike 120 minus your average premium 91.33 is 28.67, a little bit higher than the current prevailing share price. So yeah, that's kind of how that math works in that regard. But let's look at like one of those orders in the morning there to see how that actually comes through, comes across the tape, hits the flow, comes through as bullish, being sold at the bid. Selling puts, it does have a bullish sentiment to it. And let's see here. Shortly after the open, at 22s, buying $22. Yeah, I don't know. See, that's because of the time here. I see long diagonal spread bullish puts. That's possible, yeah. A little bit of a strategy here where I buy $22 puts for June while selling the 120 puts for January. See, I cash in on both ends of the trade there. But I think that's just the timing of the fill. So, yeah, very interesting, though. Very cool to see. And you can look at all of this when you have unusual whales. It'll help break it down for you. And then you can use all their resources and educational information to just try to get yourself up to speed. Same with like the 105 puts, 632 volume, and then half of that in open interest. So yeah, so somebody said, "Hey, oh, you want to sell us $105 puts?" Market maker's like, "Well, I don't just give out premium for free." Boom. Well, you're gonna own shares. That person's like, "That's fine. That didn't bother me. I wanted them anyway. I just didn't want to buy them and disturb the market per se." A short seller could also do the same thing. They could sell the stock short and then use these to cover it without disrupting. For example, because the volume of 632, I think a lot of people get caught up in the millions of dollars worth in puts, but what needs to also be looked at is the size. As the 632 only represents 63,000 shares. It's not a lot, but 63,000 shares, 63,200 shares is what that represents at the current price, which GameStop trading at the time of this video is 1.79 mil. So a little bit less, obviously, than the option premium there. So, yeah. But you would already have received the option premium. It would factor into the math. But yeah, that's on those, the deep in the money puts. And like here, you want to use like Google. You can even use Google to read up more about, why would you sell deep in the money puts? Option strategy, where investors sell put options with a strike price significantly higher than the current market price. This strategy can be employed for various reasons, primarily centered around generate income and potentially acquiring shares at a desired price. When selling put options, seller receives a premium And deep in the money puts command higher premium, because we talked about this before, because they carry that high intrinsic value, and the premium collected represents potential income for the seller, regardless of whether the option is exercised or not. So, how you would acquire shares at a discount, we just talked about that with the math. If the underlying asset's price falls below the strike at expiration, the put option buyer will likely exercise. This obligates the put seller to buy the shares at the strike, which is higher than the market. Effectively, the put seller acquires shares at a price they were previously, that's important here, previously willing to pay, aka the strike price, potentially at a discount compared to the initial market price. So that's just kind of the arbitrage that exists within that deep in the money put option. So definitely recommend, getting out there, getting into some resources. You want to get more familiar with deep in the money puts because there's a few different scenarios that could happen in that regard. Whether it be a short seller, somebody using it to generate income, whether it's somebody using it for a synthetic long position, essentially. It's selling deep in the money puts can be compared to selling cover calls. However, cover calls have greater profit potential as stock rises, while deep in the money puts just provide great like downside protection. So, cash secured put strategy is often compared to selling puts, where cash secured put intends basically you intend to buy the shares at the strike price if assigned, while a deep in the money put seller might be aiming for income generation. So, basically, in summary, selling deep in the money puts can be a strategic approach to generate income and potentially acquire shares at a desired price, but comes with risk and requires careful consideration. So, highly recommend you reading more about that. I've shared a ton of resources. I've covered it on previous YouTube videos. $18, 18 million GameStop puts explained. We covered it here. I covered it in X quite a few times as well. So yeah, a few places that it is available. Made a video separately about these before, just this kind of concept before when we were talking about the $95 puts. So definitely something to check out in that regard. As we get ready for the market is open now, and we look at that GameStop daily chart yesterday. Let's see here. I wanted to look yesterday. The high 29.19, which was awesome to see with a close above your EMA. This morning, as we're just opening, 28.58. Here's your EMAs and your 50 and your 200. Not a bad looking chart as we head into the short week next week and the holiday weekend. But yeah, that's what I got for you today with that. More on those options and the puts and what that meant, where the money was spent on that flow yesterday. But I hope you all have a fabulous day. Please like and share the video. If you have questions, leave a reply down below and I'll get back to you. And I hope you all have a fabulous day and happy Thursday to you.